Are the reasons to believe that the U.S. stock market is overvalued? Frankly, there are several reasons. There are some headline data such as price to earnings ratio, price to book ratios, price to sales ratios. More specifically, there is a more inclusive measure of value known as the cyclically adjusted price earnings ratio, which today stands at not all-time highs, but certainly at levels which are well above long-term expectations. What is that CAPE measure and how does it fit into the conversation? Robert Shiller, a noted finance professor, and his colleague John Campbell felt that earnings measures, as they were reported in the United States, were just a bit too volatile to be reliable indicators of overall financial value. So what they did was they created a more inclusive measure of earnings. Namely, they looked back about 10 years and they said, what's the average earnings for such and such a company or such and such an index? It's called the cyclically adjusted price earnings multiple, and its acronym is CAPE for short, C-A-P-E. What does recent history tell us about the CAPE? One of the more interesting phenomenon about the CAPE ratio is that there's really only been 7 months of the past 29 years when the current measured CAPE ratio was lower than its historical average. And during that 29-year period, we've had 3 different recessions. So certainly we've been exposed to a wide variety of economic cycles. This is a pretty long period of time, and yet the CAPE ratio has been flashing a red light, a blinking red light for the past 29 years. That suggests that maybe something else has been going on in more recent history. Since the financial crisis, all the central banks across the world have basically coordinated to depress the price of money, namely the interest rate. So one of the consequences of having low interest rates is that the competition for the investor dollar has tilted in favor of equities. And right now, bonds just don't do very well. Consequently, stocks with their low dividend yields are very competitive with, for example, the 10-year Treasury that is basically the benchmark for U.S. marketplaces. What does the CAPE ratio say about future stock returns? Well, there's a misperception that a CAPE ratio that's trading above its long-term average is going to portend negative returns. That's not really the case. Based on where the CAPE ratio is today, the model suggests that real return should be somewhere between 1% and 1.5%. That doesn't sound like much, but compared to the bond markets today, which are highly repressed due to aggressive central bank action, it's probably a better alternative if you're looking for long-term growth. Well, where are we now? According to the most recent data published by Robert Shiller, this CAPE ratio, as I've described, is trading at a level of about between 29 and 30. The long-term average for the United States over the last 130 years or so has been about 14 or 15. Conversely, foreign stocks are trading at or below their long-term averages. They're trading at about 15. So if you just look at that, again, from a very high level, it looks like the U.S. is high, foreign stocks are low or fairly valued.